Ever wondered why crypto feels like the Wild West? Even after all these years, one day Bitcoin is called a commodity, another day it's token treated like a security. One company gets sued, another company gets approved, and the average person is left asking one simple question: who is actually in charge of this market? That is why the Clarity Act matters. This is not just another boring government bill. This could be one of the biggest turning points for crypto in the United States, and it could affect Bitcoin, Ethereum, XRP, stablecoins, exchanges, investors, and even the banks. Before we go deeper, which city are you watching from today? Put it in the comments because I always like to see where people are watching from. Now let's break this down in plain English. For years, crypto companies have been stuck in a messy system. The government did not give clear rules first. Instead, many companies found out they were in trouble after the fact. That is what people call regulation by enforcement. It means companies build something, launch something, or sell something, and later the government steps in and says, wait a minute, you broke the rules. But here is the problem. If the rules were never clear in the first place, how is anyone supposed to follow them? That is where the Clarity Act comes in. The goal is simple. It is supposed to help decide when a digital asset is a security and when is a commodity. That might sound boring, but it's a massive deal. If a crypto token is treated like a security, the Securities and Exchange Commission, known as the SEC, has more control over it. If it is treated like a commodity, then the Commodity Futures Trading Commission, known as the CFTC, has more control. That difference matters because it changes how companies operate, how exchanges list tokens, how investors are protected, and how much risk exists in the market. Now think about XRP for a second. XRP spent years dealing with legal uncertainty. Investors did not just worry about price, they worried about whether the rules would destroy momentum. That kind of uncertainty scares away big money. It scares away institutions. It makes companies nervous. And when big companies is nervous, the market does not move the way it could. So if the Clarity Act gives cleaner rules that could help the entire crypto space mature, it does not mean every coin will go up. Let's not be foolish. Bad projects will still be bad projects. Weak tokens will still disappear, but strong projects may finally get a clearer road to grow. Now, the big fight right now is stablecoin yield. This is where the story gets very interesting. A stablecoin is usually designed to stay close to the value of $1. People use stablecoin to move money quickly, trade crypto, and sometimes earn rewards. But banks do not like that. And honestly, you can understand why. The banks have had control over deposits and interest for a very long time. If people can hold stable coins and earn better rewards through crypto platforms or DeFi systems, then banks suddenly have the real competition. And big banks do not like competition when it threatens their profits. So lawmakers have been trying to decide what kind of stablecoin rewards should be allowed and what kind should be banned. From what is being discussed, rewards that act like normal bank interest may be restricted, but rewards connected to real platform activity may still be allowed. Now that sounds simple, but there's still a gray area. What counts as real platform activity? Who decides what? What disclosures will be required? What reward programs will be approved? These details matter. Details matter because companies like Coinbase and other platforms may need to redesign how they offer rewards. They may not be able to say, here is interest on your stablecoin. Instead, they may need to build reward systems that fit inside the new rules. That is why this build matters. It could decide who wins, who loses, and has to change their business model. Now let's talk about bigger picture. If the United States finally builds clear crypto rules that could bring more confidence into the market, big institutions do not like guessing. Pension funds do not like guessing. Banks do not like guessing. Major investor firms do not like guessing. They want rules. They want legal protection. They want to know where the lines are before they move billions of dollars. This is why clear regulation can actually help crypto instead of hurting it. Some people hear the word regulation and think it always means bad news. That is not always true. Bad regulation can hurt market. Bad regulation can hurt a market. Confusing regulations can freeze a market. But clear regulation can bring trust. And trust brings larger players. Larger players bring more money. More money can bring more liquidity. And more liquidity can make a market stronger. But here is the part people need to understand. This does not mean you should run out and buy every coin you see. That would be a mistake. Clarity does not turn garbage into gold. If a project has no real use, no strong team, no adoption, and no reason to exist, regulation will not save it. But for serious projects, clearly rules help separate the real builders from hype machines. Bitcoin is already viewed by many as the strongest digital assets because it is decentralized and has a clear supply limit. Ethereum has a massive ecosystem, but it still faces questions because so many applications, tokens, and are built on top of it. XRP is different because it is tied to payments, settlements, and cross-border money movement. Stable coins are different, again, because they are tied directly to digital dollars. So this bill could affect each part of the market in a different way. Bitcoin may benefit from more institutional confidence. Ethereum may benefit if developers get clearer rules. XRP may benefit if payments-focused crypto gets a cleaner legal path. Stablecoin may benefit if companies know exactly what they can and cannot offer. But again, this is not a magic button. Markets still move based on interest rates, liquidity, investors' emotion, and government policy, and global events. Now let's bring this back to the average person watching this video. Why should you care? You should care because crypto is not just about coins going up and down anymore. Crypto is becoming part of a financial system. Banks are paying attention. Governments are paying attention. Wall Street is paying attention. Payment companies are paying attention, and whenever the biggest players in the world start paying attention, they should pay attention too. Not because you should blindly invest, but because you need to understand where money is moving. The next few years may decide whether crypto stays as a risky side market or becomes a normal part of banking, payments, investments, and global finance. That is why this moment matters. If the Clarity Act moves forward, the United States may finally be saying crypto is not going away, so we need rules for it. That is a major shift from years. The attitude seems to be, let's slow this down, companies, and keep control. Now the attitude may be changing too. Let's define the rules, build the system. That is a big difference. But here is my honest warning. Do not get caught up in hype. Every time crypto news comes out, someone online will tell you this is the moment everything explodes. Maybe it helps the market. Maybe it does not. And maybe Bitcoin breaks higher. Maybe it struggles. Maybe XRP gets attention. Maybe stablecoin companies adjust and keep growing. But smart investors do not just chase headlines. Smart investors ask better questions. What does this change? Who benefits? Who loses? What still has to happen? What risk still is on the table? And most importantly, am I investing because I understand the opportunity or because I'm afraid of missing out? That question matters. Fear of missing out has destroyed more investors than bad news ever has. So here is the bottom line. The Clarity Act could be a major step towards cleaning up the crypto market. It could be help define which assets are securities and which are commodities. It could reduce confusion between the SEC and the CFTC. It could bring stronger rules for stablecoins. It could force platforms to change how they offer rewards. And it could give serious crypto companies a clear path forward. But it will not fix every problem. It will not protect people from bad decisions. It will not make every token valuable. And it will not move risk from the market. What it could do is bring structure, and structure is what this industry has been missing for a long time. So watch this closely because if crypto gets clearer rules, the next stage of this market could look very different from the last one. The wild guessing game may slowly turn into a more serious financial system. And when that happens, the people who understand what is going on will be in a much better position. When the people who follow only follow the noise, so my advice is simple. Stay informed, do not chase hype, learn what these laws actually mean, and understand that the future of crypto may not be built by the loudest people online. It may be built by people, companies, and investors who understand the rules before everyone else does. Leave a comment so we can keep the conversation going.